Friends, thank you for being here today. What happens when the world's safest currency starts to look less safe? When the very system that powers global trade begins to wobble under its own weight? Because behind every headline about deficits and interest rates lies a deeper question. What happens when confidence itself becomes the risk? The dollar isn't just America's money, it's the world's bloodstream. And if that pulse starts to falter, the shock won't stop in Washington. It'll race through every economy on Earth. Why the dollar became the world's currency. What if the bedrock of global finance begins to crack? To understand that question, we first need to remember how the dollar became the bedrock in the first place. In the ashes of World War II, the world needed stability, and America offered it. The British pound, once the symbol of empire and trade, had been exhausted by war and debt. At Bretton Woods in 1944, nations gathered not just to rebuild economies, but to rebuild trust. They anchored global finance to something tangible, gold, and to someone powerful enough to protect it, the United States. The dollar became the hinge of this new order, redeemable in gold and backed by the world's most productive economy. By the 1950s, American banks, industries, and treasury markets formed a financial ecosystem too deep to replace. Network effects took hold. The more nations used dollars, the more valuable and liquid the dollar became. Confidence in U.S. courts, property rights, and open markets turned that confidence into habit, and that habit into dominance. But the very architecture that gave the U.S. its exorbitant privilege also created a quiet dependency. The world's prosperity began flowing through the veins of one currency and one central bank. What looked like stability was, in many ways, concentration. And concentration in finance always hides fragility. But this crown of the dollar masks a growing storm beneath the surface. What's the debt bomb under the U.S. balance sheet? Could the world's most trusted currency become the next largest liability? The United States enjoys a privilege no empire before it ever mastered so completely: the ability to borrow in its own currency, at interest rates the rest of the world can only envy. For decades, foreign central banks, corporations, and sovereign funds have poured capital into U.S. treasuries, not out of charity, but because dollar assets are deep, liquid, and safe. That relentless demand has financed Washington's deficits with astonishing ease. But beneath this comfort lies imbalance. The IMF's World Economic Outlook warns that U.S. federal debt is approaching levels unseen since World War II, projected above 120% of GDP by 2030, if current trajectories hold. Year after year, the Treasury issues trillions in new securities, not to fund expansion, but simply to roll over old debt and maintain government operations. The American economy is running on confidence that buyers will always be there. That faith is what economists call the exorbitant privilege. It allows Washington to spend more, borrow cheaper, and defer hard choices longer than any other nation. Yet privilege breeds dependency. Roughly one-third of all publicly held U.S. debt now sits in foreign hands, with Japan and China among the largest holders. This means global savings, not domestic austerity, keep the U.S. machine humming. And therein lies the paradox. The same inflows that strengthen the dollar also tighten its leash. When foreign investors buy treasuries, they keep the dollar high, U.S. exports expensive, and trade deficits persistent. The more America borrows, the more dollars the world must hold. The more dollars the world holds, the more America must borrow to supply them. It is a circular symbiosis that looks sustainable until confidence wavers. If inflation surprises, if fiscal gridlock deepens, or if foreign central banks diversify reserves even modestly, that circular flow could turn into a feedback loop of weakness. A mild sell-off in treasuries could push yields higher, raising borrowing costs, deepening deficits, and further eroding trust, the same mechanism that once retired the British pound from its throne. For now, investors still view treasuries as the ultimate refuge. But every refuge is safe only until it's tested. The question is not whether America can print money, it's whether the world will always want what it prints. And yet this architecture of dominance also carries a giant risk if the foundation is shaken. How does the global monetary system depend on the dollar? Imagine entire trade systems grinding to a halt because the anchor currency falters. That's the scale of dependency the modern world has built around the US dollar. It isn't just America's money, it's the bloodstream of global finance. Nearly 60% of the world's official foreign exchange reserves are still held in dollars, according to the IMF's latest data. Central banks from Seoul to São Paulo store them not only for safety, but because nearly everything that matters in international trade, oil, wheat, semiconductors, even shipping contracts, is priced and settled in dollars. When a Chilean miner sells copper to China, the invoice is often in dollars. When an Indonesian firm borrows from a European bank, the loan is usually in dollars. This dollar architecture extends beyond reserves and trade. Roughly half of all cross-border debt and more than 40% of global payments flow through the dollar system. Multinational corporations hedge, invest, and report in dollars because it reduces friction. Banks hold dollar liquidity because everyone else does. It's a self-reinforcing network, a monetary web, so interconnected that its functioning depends on constant confidence in the U.S. financial core. But network strength can become network risk. When the dollar rises sharply, emerging markets suffocate under the weight of their dollar debts, as local currencies weaken and repayments swell. When U.S. interest rates climb, global capital floods back to American assets, draining liquidity from developing economies. In good times, this system feels efficient. In bad times, it becomes suffocating. What began as a design for stability after World War II has evolved into a structure where the same currency used for safety can trigger crisis. A single policy move by the Federal Reserve now sends shockwaves through commodity prices, debt markets, and household costs from Lagos to Lahore. The dollar's dominance magnifies America's influence, but it also centralizes fragility. And as other powers experiment with digital currencies, bilateral trade in local money, and regional payment systems, the question is no longer whether the dollar will stay supreme, but whether the world can withstand what happens if it stumbles. So when cracks appear in the dollar's armor, the ripple effects are not just American, they're global. Are the warning lights flashing for the U.S. economy? What happens when the world's engine sputters while everyone's still expecting full speed? For decades, the United States has been the heartbeat of global demand, the buyer, borrower, and benchmark for growth. But beneath the confident headlines, the indicators are flashing red. The Conference Board's leading economic index, a composite gauge of forward-looking metrics, has been sliding for months. Industrial production has softened, consumer sentiment wavers, and business confidence remains trapped in uncertainty. Even as the unemployment rate stays low, productivity growth has stalled, a warning that the economy may be running hot but not strong. Inflation, though off its peak, has proven stubborn. Core prices remain elevated across housing and services, forcing the Federal Reserve to keep interest rates higher for longer. Those higher rates ripple outward, squeezing small businesses, slowing real estate, and raising the cost of financing the very debt that underpins Washington's fiscal structure. Every percentage point of higher yield adds billions to the annual interest bill, compounding the very imbalance that sustains the dollar's reach. Then come the tariffs. What began as tactical trade leverage has hardened into structural friction. Recent tariffs on Chinese, European, and Mexican imports may protect certain sectors in the short term, but McKinsey's surveys show persistent supply chain vulnerabilities, longer lead times, higher costs, and mounting uncertainty for U.S. manufacturers. When global supply lines falter, inflation risks reappear and competitiveness erodes, a vicious loop that chips away at economic credibility. Meanwhile, export momentum has weakened. The once dominant U.S. manufacturing sector faces twin pressures: a strong dollar making its goods expensive abroad, and shifting global demand patterns that favor regional trade blocs. The U.S. economy still looks large and liquid, but the growth engine behind that image is grinding under structural strain. Here lies the paradox. The world buys dollars because it trusts the U.S. economy, yet that very trust masks how fragile the foundations have become. Investors still see the Treasury market as an unshakable fortress, but inside the fortress, fiscal walls are thinning and political gridlock blocks repairs. The appearance of safety persists because no one dares imagine its absence. The dollar remains the world's anchor, though the system it supports faces rising challenges. But the risks escalate further when you connect the domestic cracks to the global facade. What happens when global confidence in the dollar wobbles? The dollar may not crash overnight, but what if it begins to quietly slip from its pedestal? Confidence, once shaken, rarely returns intact. The dollar's supremacy rests less on law than on belief. Belief that the U.S. will remain solvent, its markets liquid, and its institutions reliable. But if that belief erodes, even gradually, The effects can cascade through every corner of the global economy. It would start with diversification. Central banks, wary of overexposure, might begin trimming dollar reserves in favor of gold, euros, or yuan. Investors, sensing a structural shift, could demand higher yields on treasuries to offset rising risk. The immediate result: higher U.S. borrowing costs and renewed fiscal pressure. A 1% jump in treasury yields adds hundreds of billions in future interest obligations, tightening the very debt trap that now defines Washington's balance sheet. As foreign demand cools, the dollar could depreciate, making imports more expensive and rekindling inflationary pressures. What once was America's shield, the ability to print the world's reserve currency, becomes a conduit for instability. Rising prices would eat into real incomes. The Fed would face a painful trade-off between tightening to protect the dollar or easing to support growth, and markets would oscillate between inflation panic and recession fear. The global fallout could be severe. Trillions in cross-border loans, trade invoices, and commodities priced in dollars would reprice simultaneously. Emerging markets could suffer liquidity squeezes, while corporations with dollar liabilities scramble for funding. The world's financial plumbing, built for a strong dollar, would struggle to adapt to a weak one. Roland Berger's analysis notes that even a partial reallocation of reserves away from the dollar could reshape global capital flows, empowering regional blocs and altering the hierarchy of economic influence. For the U.S., this means a slow erosion of geopolitical leverage. Sanctions, trade negotiations, and foreign aid all depend on the dollar's gravitational pull. If that pull weakens, so does Washington's reach. This is not a prediction of collapse, but a recognition of symmetry. What the dollar once gave, cheap capital, control, and confidence, it can also take away. As Investec warns, a decline in dollar dominance would change the rules of the game, not just the scoreboard. And if the dollar falls, the shockwaves hit not just Wall Street, but Main Street and beyond. Who gains if the dollar loses ground? What if the dollar slipping becomes someone else's gain, but many more lose? Every currency tells a story of power, and for decades that story has centered on Washington. Yet as cracks appear in the dollar's dominance, other capitals are writing new chapters: Beijing, New Delhi, Moscow, even Riyadh. Across the global south, nations have grown wary of a system that exposes them to America's policy swings and sanctions. China, through its cross-border interbank payment system, CIPS, has quietly built an alternative infrastructure for trade settlement outside the SWIFT network. India now settles part of its energy imports in rupees. And Russia, once dependent on the dollar, has turned sharply toward yuan-based transactions. Each step may look minor, but together they sketch a slow-motion pivot, a world learning to trade without a single monetary overlord. According to OMFEF's 2025 analysis, currencies like the euro, yuan, and even regional units in Asia and the Middle East could capture modest slices of global reserves if dollar erosion continues. But this isn't a simple transfer of power. It's a rebalancing fraught with contradictions. The euro offers stability but not unity. The yuan carries ambition but not full convertibility. The rupee and Gulf currencies have local strength but limited reach. The likely outcome is fragmentation, a mosaic of regional hubs rather than a new universal anchor. For countries long constrained by dollar cycles, a weaker greenback could mean breathing room, cheaper debt repayments, stronger export competitiveness, and reduced vulnerability to Federal Reserve shocks. But for others, especially economies dependent on dollar liquidity, it could mean volatility, inflation, and market uncertainty. The fall of one center may empower several peripheries, yet it also multiplies risk. As the hedge fund journal notes, currency diversification spreads opportunity, but not immunity. In other words, de-dollarization is less a revolution than a redistribution of both power and peril. If the 20th century was defined by the world converging around the dollar, the 21st may be defined by nations cautiously diverging from it, not in defiance, but in self-preservation. And those shifts don't just change currency tables, they rewrite global power maps. Global chain reaction, from Pakistan to ASEAN and the Middle East. A fault in the dollar's spine doesn't stay in Washington. It fractures everywhere. When the dollar weakens or wobbles, the shock doesn't end with U.S. bond traders. It ripples across continents through trade ledgers, oil contracts, and sovereign balance sheets, hitting hardest where economies lean most on the greenback. In Pakistan, the story is familiar. Debt repayments are largely denominated in dollars, while export earnings come in weaker local currency. A swing in the dollar's value instantly changes the math of survival. When the dollar appreciates, foreign debt balloons. When it depreciates, global investors flee to safety elsewhere, draining capital from fragile markets. Islamabad's budget planners aren't just tracking domestic policy, they're tracking the Federal Reserve's next sentence. Across Southeast Asia, the picture rhymes. ASEAN economies, from Indonesia and Malaysia to Thailand and Vietnam, finance infrastructure and trade through dollar-based systems. A weaker dollar can ease repayment burdens temporarily, but it also disrupts pricing across commodities and imports. Inflation spikes when currency mismatches grow. Central banks are forced to burn reserves, often held in dollars, just to defend exchange rates. According to Investopedia's global reserve data, many of these nations maintain massive FX buffers precisely to cushion against such dollar volatility, a cost of living in a dollar-centric world. In the Middle East, the dollar's pulse beats through every barrel of oil. Energy sales are still largely priced in dollars, linking regional budgets directly to U.S. monetary tides. Gulf economies with dollar pegs face a painful paradox. When U.S. interest rates rise to defend the dollar, local economies tighten, even if domestic conditions don't warrant it. Some producers have begun experimenting with yuan or euro-based energy trades, but as Responsible Statecraft notes, these shifts remain partial, not revolutionary. The global energy architecture still bends toward the dollar's gravity. Every link in this chain, from debt to trade to reserves, connects back to a single node. That concentration made global finance efficient, but dangerously synchronized. When the dollar sneezes, global markets catch pneumonia. So, a U.S. problem quickly becomes an emerging market crisis, a trade disruption, a food shock, or a debt default. The dollar's reach once stabilized the world, now it amplifies every tremor. So when the dollar falters, the whole global financial arena rocks, starting at the edges and coming home to roost. What are the triggers and time bombs? Because when multiple pressures converge, the adjustment can come faster than expected. The dollar's potential crisis won't emerge from mystery. It will come from pressures already visible, converging into a moment of lost confidence. The first and most visible fault line is fiscal. U.S. deficits are ballooning again, not in wartime or recession, but in the midst of steady employment and moderate growth. Washington is issuing trillions in new debt just to keep the system running. The more treasuries flood the market, the more the U.S. relies on foreign buyers to absorb them. If that demand falters, if Japan, China, or major sovereign funds step back, yields will spike, debt costs will soar, and fiscal sustainability will appear less certain. Confidence, not capacity, becomes the problem. Then come the interest rate and inflation triggers. To defend the dollar and tame prices, the Federal Reserve has kept policy tight, but high rates strain the very balance sheet the Fed aims to protect. Corporate defaults creep upward, mortgage markets freeze, and consumer demand softens. Should inflation flare again, the Fed faces a trap: raise rates further and risk recession, or cut and risk currency flight. Either choice could ignite volatility in global capital flows. Trade policy adds another fuse. McKinsey's analysis shows that tariff escalation, especially between major economies, acts like an invisible tax, raising costs, breaking supply chains, and distorting investment. A sudden tariff surge or a geopolitical rupture in key trade corridors could slash global growth by hundreds of billions of dollars annually, tightening liquidity everywhere. Finally, de-dollarization itself is both symptom and accelerant. Each new bilateral settlement outside the dollar, whether in yuan, rupees, or local currencies, slightly reduces global dollar demand. The effect is slow but cumulative, weakening the network that keeps the system self-sustaining. When fewer nations need dollars, the feedback loop reverses. An implosion of confidence, then, is not a vast surprise. It's the predictable outcome of known stress points, fiscal excess, rising rates, trade fragmentation, and eroding trust. The world has seen these warning lights before. It's just learned to look away. As we demarcate these trigger zones, the question becomes not if, but when, and how severe. How might the U.S. and the world respond? The next move could determine whether this becomes a correction or a collapse. For the United States and its partners, the challenge now is not to predict the dollar's decline, but to manage its consequences before confidence unravels completely. Washington's first lever is fiscal. The IMF's External Sector Report 2025 warns that persistent U.S. deficits are the system's weakest joint, a vulnerability solvable only through credible consolidation. That means restraining discretionary spending, reforming entitlements, and rebalancing taxation towards sustainability. Yet every election cycle turns fiscal prudence into political suicide. and delay keeps pushing the correction forward. Still, even symbolic progress, a bipartisan framework for debt reduction or transparent long-term budgeting, could buy markets time and calm. Monetary policy, meanwhile, must navigate a narrow corridor. The Federal Reserve can't defend both growth and the dollar indefinitely. Deloitte's Q3 forecast highlights how high rates are already cooling consumption and business investment, hinting at the limits of monetary endurance. The Fed may attempt a gradual recalibration, lowering rates while coordinating with the Treasury to anchor confidence through clear communication. That alignment, rather than aggression, could steady expectations. Rebuilding competitiveness offers the deeper solution. The U.S. still possesses unrivaled innovation, energy potential, and human capital. If Washington channels those strengths into manufacturing resilience, clean energy investment, and technological leadership, it could offset monetary weakness with real economic value. The dollar's ultimate defense is not rhetoric, it's productivity. Globally, adaptation is already underway. Central banks are diversifying reserves, experimenting with multilateral clearing systems, and expanding bilateral trade in local currencies. ASEAN finance ministers discuss shared settlement platforms. The BRICS bloc explores digital currency linkages. Yet even as alternatives emerge, most nations quietly prefer the dollar's liquidity to uncertainty. The system may bend, but it resists breaking because everyone, debtor and creditor alike, needs stability more than revolution. Flexibility, then, is the only winning strategy. For the U.S., it means policy discipline. For the world, cooperation without fragmentation. The danger isn't that the system changes too fast, it's that it doesn't change at all. The next chapter depends on whether policymakers act and whether markets believe they will. So what comes next, and why everyone should care? The wheel of global finance may turn, and the world could wake up one morning asking, what happened to the dollar? Every financial era evolves quietly at first. The IMF's April 2025 blog, "The Global Economy Enters a New Era," warns that we're now crossing a structural threshold. The financial order that powered 70 years of globalization is showing its age. The US dollar, once the unchallenged anchor of trade, debt, and confidence, is beginning to face the same test every empire's currency eventually meets: the question of endurance. The risk isn't collapse overnight. It's erosion over years, through twin deficits, weaponized tariffs, shrinking reserves, and the slow migration of trust. As Investec's 2025 Outlook notes, investors aren't abandoning the dollar, but they are hedging against it. That subtle shift, from faith to caution, is how every financial transformation begins. For viewers, this isn't a distant academic story. A weaker dollar could rewrite everything from the price of fuel to the safety of savings, from the stability of emerging markets to the direction of global power. If the greenback stumbles, the tremors won't stop at Wall Street, they'll ripple through Karachi, Jakarta, and London alike. So what should we watch? 3 signals. U.S. deficits that refuse to shrink, global trade corridors bypassing the dollar, and the moment central banks start buying fewer U.S. treasuries. Each will tell us how far the world has drifted from America's financial orbit, and whether it's ready for what comes next. The era of dollar dominance may be entering its final act. What we do next will matter for decades, because when a currency defines a century, its fate defines the world that follows.